So when people think, oh, I've got FDIC insured money at the bank, okay, guess what? 3 banks that went out this year took $36 billion of the $122 billion that was available. 3 banks. The life insurance companies that I have my cash value with, guess how much they've ever taken from their guarantee associations? And guess how much in the state of Utah, for example, has ever been tapped into on the money that's guaranteed? $0. And it's $300,000, not $250,000. So this is what the banks are doing anyway. You put your money in a bank, they take 1/3 of their reserves and put it in cash value because that's what's legally allowed. So why would you let them get that extra return when you could just get it?
Let's talk a little bit about life insurance. This is something that you've been in since the early days. For me, when I got into whole life insurance, people around me thought I was crazy. People literally are like, you don't have a family. You're not married. You have no kids. What are you doing? I mean, all the people around me were saying that. But the one thing that I noticed, and the reason I moved forward, is because all the wealthy people I knew did it and shared all the reasons why they would do it and how they use it for investments and how it's creditor protected and all these different things about it. And I was like, well, I probably, if I'm going to follow what everyone does, that the crowd is not financially free. The crowd is not an expert. Why don't I pay attention to those that are doing really well? So literally, that's how I made my decision. Whatever the majority of people are doing, run the other direction. That's how I made that decision and many other decisions in my life, mobile home parks, you name it. Don't follow the crowd and do what the most successful people do. So I'd love to get into some of the life insurance and how you got into it and why you're such a big believer in it. Like, how can we use this as entrepreneurs, as business professionals? How can we use this to our advantage?
So in June of 1998, I got insurance license at 19 years old. And I also got my 6 and 63. And at the time, I was basically peddling mutual funds. I've apologized and repented. Growing up as a Catholic, I went to, the whole thing. So, but then when the market went down in 2000, I got really concerned because I didn't really know what I was doing, and my clients were like mom and dad, grandma and grandpa, all my friends' parents. And when I would tell them they were in it for the long haul, that's what my firm wanted to say. I'm like, that sounds terrible. That sounds like a dumb CrossFit workout that someone posts about, because they're going up a hill for 10 years. I don't know. And then they said the market's on sale. I'm like, that would have been good to know before I sold this, because now it's on sale, but that's a loss for the person, not a benefit. And so I decided to fly somewhere once a month and use my young age to my advantage to say, who are the brightest minds that I could talk to? And I was able to get into a family office, and I was watching them do a $400 million life insurance transaction. And I was watching the attorneys analyzing it. I was watching the due diligence people. And this is the first time I'd seen due diligence. Due diligence in finance is like Sasquatch. You hear about it a lot, but nobody's ever actually seen it for people that are selling mutual funds. So that changed my life, because the first thing I noticed is in that family office that they emphasized tax first. That's why I got really good at tax. And I saw that their budget for the accounting team was substantial. And I was like, wait, there's ways to get guaranteed returns. It's if you save on tax, if you save on interest, if you save on non-performing fees, and if you eliminate duplicate coverages or improper structure with insurances. So you could keep more of what you make by simply being more efficient. And this notion of how they were allocating, that's what led me down this process of writing What Would the Rockefellers Do? Because I ended up getting to talk to a CPA on the Rockefeller family office. And in those interviews, I started to figure out that they were allocating a lot of money towards life insurance, not because they saw it as an investment. They saw it as an alternative to a bond portfolio. A bond portfolio has capital depreciation risk when interest rates go up like they have been. You start losing your principal. If it's not a municipal bond, it's taxable. It's subject to creditors and liability, like it's exposed. And so ultimately, the time that people make the most money in investing is when markets go down. All of a sudden, business deals become really good. All of a sudden, you can get real estate deals that you couldn't get before because they were too competitive when everybody was flush with cash and the banks were lending money that was so easy and interest rates were so low. So what I realized is you could now make an asset allocation decision where your money is protected from bankruptcy and liability. Once a dividend is paid, it becomes the guaranteed amount. So even in a downturn, your money's protected and guaranteed. And then you get a death benefit. And my philosophy that I saw after interviewing the Rockefeller, CPA, was why not buy your net worth and then focus on building cash flow? Because most people, as Justin highlighted this morning, don't know how to tap into their net worth to make it beneficial to their life. It's merely like the bicep. It's bragging rights, and you can talk about it, but it's not as functional as a hamstring. Hamstring, like the blood of the body is the cash flow. It's the lifeblood of what you're doing. And so if you have this death benefit now, versus what happens with a lot of financial people is they say, just buy some term and invest the difference. And then what happens is you become really successful and you meet with an attorney later on, they say, hey, you have an estate tax problem. So now that you're old, let's buy some life insurance, which is an expense for you, versus an allocation that is comparable to your bonds. And this is the study. Risk adjusted, you'll take half the risk in cash value than you will with the bond. And after 7 years, when designed properly, you'll actually be ahead or equal to a bond portfolio. But now you have access to the capital along the way. You don't pay taxes on the gains. It comes out FIFO, meaning any money you put in first is the first money you get to take out. Therefore, if you take a withdrawal instead of a loan, it's tax-free first before taxable, which is the opposite of almost every other investment. And your death benefit is available in accelerated benefit riders if you ever need long-term care, which might mean that you don't have to buy those types of policies because you now have this death benefit that you could tap into. If you become disabled, the premium payments will be made for you after 6 months, so it could still go even if you're not in a good position. And again, you can capitalize on other assets with the cash value over time. Now, cash value has done better in the last 20 years than other fixed income assets, right? Savings accounts have been low, bonds have been low on interest. What I'm gonna tell you is they're gonna lag bonds for a while here, because bond interest rates, if you buy treasuries right now, you're like 5%. They're more anemic and slow. They're gonna take a while to build cash value and raise those interest rates like the other instruments. But what happens is when things go down, it's slower to go to lower interest rate. When things go up, it's a little bit slower, but you have access to that along the way. So if you have something that's good, it better be really good to tap into it. I've used it to buy businesses. I've used it to buy real estate. I've used it to launch books. I've used it over and over, but I only use it if I know I'm getting well over 10% because it was a waste of my time otherwise. Because if it's a tax efficient bond like it is inside the cash value, I don't tap into it. But I buy it primarily because the death benefit becomes something that can unlock my assets in the future and enhance them, where I might get 20, 30% more cash flow. Because most people, when they do a charitable trust, they go buy life insurance because they're like, well, when I die, the charity keeps the money. So they use up all that extra cash flow to buy a policy that they're not even tapping into the cash value, which you could tap into cash value along the way for your deals, your lifestyle deals, and know that it's safe, secure. And here's where it's really safe and secure. In 2008, we remember what happened in 2008. The FDIC had so little money compared to that debacle. The government spent $5.5 trillion above what the FDIC covered. So when people think, oh, I've got FDIC insured money at the bank. Okay, guess what? 3 banks that went out this year took $36 billion of the $122 billion that was available. 3 banks. The life insurance companies that I have my cash value with, guess how much they've ever taken from their guarantee associations. And guess how much in the state of Utah, for example, has ever been tapped into on the money that's guaranteed? $0. And it's $300,000, not $250,000. So this is what the banks are doing anyway. You put your money in a bank, they take 1/3 of their reserves and put it in cash value because that's what's legally allowed. So why would you let them get that extra return when you could just get it? You have to be patient, though. It's going to take a few years to capitalize because they have to set money aside for reserves, for a death benefit. They pay pretty big commissions to the agents, but if the agent designs it properly, they're going to get 1/3 of the commission because you're going to get a lot more cash and a lot less commission in their pockets. So you have to have someone that knows what they're doing, because some people bastardize what the Rockefellers do and sell the wrong type of insurance or heavy commission insurance, and it could take 7, 8, 9, 10 years to ever get to the point where it should be in 3 years. That's the unfortunate thing.
Yeah, by the way.
Not that I know anything about insurance. It's weird that I know about these things. Yeah.
Yeah, I mean, that right there is a masterclass session. One of the things that most people don't know is that If you look at like the solvency ratio with banks, they're anemic here in the United States. They're just so brutally bad. Even the big banks, even Chase Bank, Wells Fargo, Bank of America, the big banks, it's anemic. Life insurance companies have to have access to 100% of the proceeds if every single one of their clients died at the same time, which we all know the odds of that is slim to none. But they have to have that availability. And then the other cool thing is that we are in a rising interest rate environment, which also means the dividend is going to rise on the life insurance policies, which are going to help those perform better. And you should be able to shorten that timeline for which it becomes self-funding or you have the cash. But if structured the right way, when I did my policy, I had my cash out. I literally put money in. Within 24 hours, I had money back. I had over 90% of the cash value I put in. So I remember I was about to do a deal, and I talked to someone, and this person knew so much more about whole life than I did. And all they had to do to sell me on this, it was this, because I was like on the fence, unsure what I should do. And he said, well, you can either just go buy the asset, or you can take the same dollars that you're going to buy the asset with, put it in the life insurance policy, take it out, go buy the same asset, and now you got your money working twice. And I'm like, wait, back up. You're saying like the same dollars? Yes, the same dollars. So what sold me on life insurance was literally that strategy of, oh, well, I could either buy it or I could put it in, cycle it out, and then buy it. Why would I not do that? That's like a no-brainer. So I basically got paid about 6.5% dividend over here, and it's still earning that. And that dividend's fluctuated. Maybe it's gone down to 5 3/4, and as high as maybe 6.5, 6 3/4, right? Over this time frame, because I've been, when did I do this? So I got my policy, I think when I was 24 or 25, and I got a big corporate policy, and I was putting a lot of cash in. My job was to like put as much cash in as I possibly could. But that one example, I was like, okay, so I'm earning this dividend no matter what. And by the way, even if it doesn't perform well, I have a guaranteed minimum. So I have guaranteed money over here. This is going to act like my bond portfolio. And then over here, and by the way, there are a lot of family offices that life insurance is their bond portfolio. They don't even have a bond portfolio. Some have both. Some, this is their bond portfolio because you have exposure to bonds. Most insurance companies are primarily invested in bonds. That's how they can stay liquid. All right, I like the innovative insurance companies that do bonds and then buy businesses as well that are super profitable so that they can have the big swing upside. But I bought that asset, and that asset produced a lot of I got over 20% cash on cash return. So it's like that combination was powerful. And then the flip side is, let's say this deal went bad. Well, then I didn't lose the dividend I'm earning over here because I didn't take the money out, I borrowed against it. So either way, like I'm protecting the risk on the downside, and then I'm amplifying the return on the upside. And it's fascinating.
When I was 22 years old, and one of my first substantial clients was this guy named Steve, and he managed $5 billion in municipal bond funds. He was the #1 rated manager, Lippert, all of them, for municipal bonds. And he bought a huge life insurance policy, even though he was a bond because he understood the risk of capital depreciation. He understood it. And I remember I was so nervous to talk to him about it. He was a professor of mine because he was as a thing that he did as an adjunct professor as a way to pay it forward and give back. And that was a pretty convincing thing at 22 years old to have that conversation, someone who was infinitely more knowledgeable than me at that time, that was actually mentoring me to understand this concept of why would I be sitting in this bond portfolio when I could have this and it comes with this benefit. Hey, thanks for watching. I appreciate it. And if you're enjoying these videos, well, there's good news. More where that came from, so go ahead and click through and watch the next video now.